Welcome everyone. First, I'd like to thank the organisers for inviting me. It's very rare I do these kind of webinars, but it's always very flattering to be invited. And I'm exceptionally lucky to be here because I actually had a very close scrape with the terrorist incident in London yesterday. Had I not been 5 minutes late, it could have been a very different story. So I might not have been able to join you. It all kicked off in London, Parsons Green, which is where I live. But anyway, aside from that, today we're going to talk about how to profitably trade the news in any market. For those of you who don't know me, my name's Robert Colville. I founded the online brand, trader trading brand called The Lazy Trader. I've been trading now for about 10 years on the dot. I didn't start off trading. I actually started off as a journalist, having graduated from university, got a first degree. It wasn't long until I moved to London until I realised that actually a career in journalism certainly wasn't just not going to pay the bills, but it wasn't essentially going to be fulfilling for me. So I looked around and I saw a lot of my friends who were in the white collar professions who were certainly earning a lot more than I was and enjoying much better lifestyle in terms of more free time and more of an abundant way of living. And I wanted a slice of that. So I fell into financial markets trading and I sucked at it. I was goddamn awful, horrendous, and I made every single mistake in the book many times over until several years after I started, after becoming close to giving up on many occasions, I gravitated towards the style of trading, the higher time frames, and then I became consistent, to cut a long story short. But you know, my journey wasn't a smooth one, and ever since becoming consistent and profitable, I started off the brand thelazytrader.com, which has been in existence since 2012, and I've since taught thousands of people around the world, just like you, just like myself, how to trade currencies, stocks, and commodities. And the great thing about end-of-day trading, where we just trade the daily and the weekly time frame, is of course the time return synergy, where you can make the maximum you possibly can from the market just looking at the screen once a day or even once a week if you're trading at the weekly time frame, which allows you to fulfill the very things that you probably started trading to fulfill, like more time to spend with family, traveling, hobbies, photography, tennis. In my case, I do some mentoring for the Prince's Trust, which is a charity run by Prince Charles in London, which essentially helps and mentors people from disadvantaged backgrounds in entrepreneurship and building their own business from the ground up. Anyway, I'm pretty sure you didn't take time out of your Saturday to hear about me talking about myself. So let's get straight into the pith of today. Let's have a quick look at the disclaimer. Nothing untowards there, do not worry. And we've got quite a full itinerary, and I'm going to really condense this into about 45 minutes to an hour. So we're going to talk about how news affects the market. We're going to talk about how there are a lot of myths out there when it comes to news trading and how to debunk the nonsense, the rumors, the misinformation out there. The internet is absolutely awash with misinformation and trading. I have no idea why, but there's just a lot of it, and I would hate for you to go away after this not knowing how to news trade in the style of the lazy trader. Okay, we'll talk to you about the ingredients of successful news trading, what it really takes. You'll be surprised. You do not need to plug into like a multi-screened terminal. You don't need to invest thousands of pounds on news terminals or feeds, and you certainly can, ironically, have your news trading as a very relaxing hobby almost. You don't need to be in front of the screen whilst the news is happening. A lot of people ask me, what do you think, Rob, of non-farm payroll? What are you going to do? And my answer is generally, I don't really care, actually. I'm just going to do what I do normally. And a lot of the time, I wake up in the morning and I just trade regardless of what news is being announced. Okay, so we're going to talk about, obviously, risk management. No strategy or style of trading is complete without that cornerstone. And we'll talk to you about some trade examples as well, so we can really apply what you've learned. So how news affects the market? Well, of course, when you see currency pairs like the British pound versus the US dollar, for example, which is affectionately known as cable nickname, it's generally moved by announcements, data releases, of course, elections, referendum, key news events drive the market, and this really does vary depending. It's importance, and of course the equilibrium between value amongst buyers and sellers, which always must be reached. Okay, news is immediately factored into the market as soon as it's released. There's absolutely no point to you placing an idea which based on news which you've read in the paper, because you can bet your bottom dollar that the market has factored it in the nanosecond the news has been released already. So more often than not, you would have missed the move. And even if you did enter the market at the time of the news, it's very likely that the broker will widen spreads and you'll have to pay a much higher cost for the trade, and also you'll get a much worse fill because the markets are so volatile and erratic. Lots of people are getting in and out of the market at the time of a news event, so it's a great way to get your fingers burnt if you don't know what you're doing. Okay, but in terms of how markets move in response to the news, essentially when you see a currency pair together, all currencies are paired, it's a two-horse race between what country or economic trading bloc is doing against the other. So we've got, say, euro dollar, it's always going to be a two-horse race as to who's doing better, Europe or America, the United States. Okay, so if in America we get a news announcement that is worse than expected or worse than the market anticipated, we can expect the euro, the first in the pair, the term currency, the base currency, to go up whilst the US dollar goes down. And it's always going to be like that. The next day, if a news announcement comes out of the European Union that is worse than is expected, we can expect to see the euro go down and the US dollar go up. So it's like a seesaw motion. If one currency goes down in the pair, the other one goes up, even if there's no positive news in the currency which being paired against it. Okay, it's always going to move in tandem with each other. Okay, but what we do is we essentially use news as a catalyst to help our winning trades win big and also get out of our losing positions quickly. That's important. But before we continue, let's talk about some of these myths out there, because there are plenty of them, and a lot of people come to us and they have all these ridiculous ideas or silly little fantasies, and I think it's a worthwhile while that we debunk some of the misinformation out there before we go on to the pith of the webinar. Okay, so a lot of people think that to be a trader, in fact, you have to be exceptionally smart or mathematically gifted to trade news profitably, successfully, and seamlessly. That is not the truth. Some basic math is required, but it's not to a particularly high level. Some simple division, subtraction, and that's it really. And obviously the times table isn't really required when you've got a calculator. That's the great thing. I'm pretty bad at maths, so this is why I've got a calculator. But funnily enough, actually, the sums and the equations we need in trading are not that difficult, especially when you know how to trade size, and we'll talk about that later. Okay, so are people able to get it right the whole time when it comes to news trading and guessing what the news is going to be? Absolutely no chance. Okay, some people get it right some of the time, some people get it right most of the time, but nobody ever gets it right the whole time. Okay, and this is very important. It's essentially going to be 50-50 if you think about it in logical terms. Is news going to be in favor of your trade, or is it going to be against it? Okay, we have some very high profile people. The referendum, the EU referendum in the United Kingdom last year, I think, as far as I'm aware, Goldman Sachs lost a lot of money buying the British pound versus the US dollar when in advance of the referendum results, and they got it wrong. Okay, so sometimes the brightest and the best people get it spectacularly wrong. And Nigel Farage got it right. He bet a good amount of money on Britain leaving the EU, but does he get it right the whole time? No. Okay, and we can accept, in order to make good money from news announcements, we don't get it right the whole time, and we don't need to in order to make good money, and that's absolutely fine. But what we need to do is essentially ensure that if we do get it right, we're aligned in a potential move that rewards us and pays dividends, and if we get it wrong, we only lose a small amount of money. We'll talk about that more later. Okay, so a lot of people also think that when it comes to news trading, they need to have some kind of link to CNN, Bloomberg, and these kind of spend thousands of dollars a month on these kind of like data terminals. And again, that's a waste of money, because this will confuse you more. And if you haven't got a broker that fills you or is efficient with how they enter you into the market consistently, again, you could find yourself paying a lot of money in slippage, increased spreads, And of course, like I said, if you watch CNN, Bloomberg routinely, even if it's not for the live terminals, even though it's on the news, you'll see one pundit talking up the US dollar in the morning, one pundit talking it down in the afternoon, and the third one doesn't know what's going on in the evening. So potentially, if you're aligned with the news on a rolling basis, it will do little more than confuse you. And this is why I steer clear of it. In fact, my time as a journalist has taught me one thing. A lot of the news out there is fake news. I don't really care about it at all, actually. I don't even look at the news. Okay, and I know that's probably going beyond the scope of this webinar, but I find that there's a lot of misinformation out there, not necessarily when it comes to financial numbers, but like I mentioned to you, by the time these financial numbers, figures and releases meet the old rolling ticking printing presses and typed up in a kind of news article online and published, the market's already moved anyway. Okay, so is there a holy grail when it comes to trading and investing? Or is there a holy grail when it comes to trading and investing in the news? Absolutely no, it just does not exist, unfortunately. Okay, so is it possible to make a decent return trading the news based on the fact there's no magic pill? Absolutely. Let's show you how, because anything's possible in trading. Okay, so we'll talk about the ingredients of what is required to make a decent news trading strategy. So talking about strategy, we need a profitable strategy. I'm a swing trader. I like placing my orders and forgetting about them, whether it's on the daily or the weekly time frame, because I'm a lifestyle trader and I've never really signed up to trade intraday. I'm actually pretty bad at intraday trading as well. It's just the way my brain works, but I happen to be very good at end of day and end of week trading, because funnily enough, the best accompaniment for end of day, end of week trading for me is just having space away from the screen and not being outcome attached. A stable time frame is good for the news, like the daily or the weekly. The thing is if we've got decent wide stops on the daily and the weekly time frame, it means that a lot of these kind of intraday news spikes don't really affect our trade. Positive reward to risk, this is a big one. We always trade setups with a potential 2-to-1, so that if we are risking, say, for example, $100, we can be sure that we could potentially be getting 200 minimum back. If the trade goes the wrong way, we want to obviously bear in mind that we don't want to lose more than a certain amount, and we only trade maximum 1 or 2% of our trading account, 2% absolute maximum. We use a stop loss to get us out of the trade if the market does have other ideas, and you know, sometimes the best looking trades can sometimes bite the dust, and I'm absolutely fine with that. That's a fact of life, unfortunately. Sometimes the most obvious things in the market can go and kick your ass. But of course, you kick yourself if you saw that setup and you didn't trade it and it went your direction. Okay, that can be the real mare about trading. Okay, and the most important one for me is the ability to set the orders up, forget about it, go for a walk, do something else, and you know, come back to your trade when it comes to managing it and just being at peace with the outcome, whatever it is, whether it's a decent win or a small loss, and just accept that anything can happen at any time in financial markets. It's the power of letting go. It's very important. Okay, so in terms of profitable strategies, it's always, I know that a number of you are probably starting out trading. It took me a while to sample different strategies before I really found what kind of like resonated with my personality, or more in my case, it was more the style of trading, the end of day, end of week. That's what I liked. I trade supply and demand, pullbacks, and sell rallies in downtrends. I look at ABCD patterns, but if you want to strip it down to its bare components, you can be a reversal trader, a trend trader, or you could be trading breakouts or bounces. Okay, whatever you choose, always go for positive reward to risk. Okay, the simpler the strategy, often the better. Okay, like I mentioned, a stable time frame. The higher order time frames are always going to be more resistant to news announcements because of the intraday volatility. It means that we can benefit from longer moves. We can just move up, set our trades up and walk away, and we can be in the position, and it's slowly accumulating money over days, weeks, months, and we can just simply just let it tick along. We can add to the position if we get any retracements, and that's the beauty of trading. That is the sweet spot, rather than having to be in front of the screen every day for 3 hours in order to intraday trade. I can't think of anything worse. Say, for example, I wanted to have a nice later morning because I've been out with some friends in the evening, or I just can't be bothered. I don't want to be wedded to the computer and be trading the 5-minute chart. That for me is the definition of stress, and I'd far rather have it on the daily or the weekly time frame, where I know that I'm making, in terms of reward to risk profile, infinitely more profitable trades in terms of profit potential, and it takes less work in order to profit from them. And if they're a losing trade, then at least, of course, the risk is 1 or 2%, like it should be if you're intraday trading. Okay, but like I mentioned, just to recap, the higher the time frame, the longer the moves typically are, higher profit potential, and the trades are in tandem, far fewer in frequency. So I always look at trading a setup as almost like a business decision. I'm always going to want, like you would if you're investing in anything, whether it's an ice cream van, a stock, or anything, a business, you always want to make more than what you invested, or it's a waste of time. I mean, banks give you kind of like well, they used to back in the good old bad old days, a decent interest rate per year. No longer the case, but that could change very soon with the way interest rates are rising. Essentially, you want a reward via risk, and unless I get at least twice in potential reward payout than what I'm risking, I'm not interested in the trade. I'd rather keep my gunpowder dry for the next opportunity, rather than just getting into a trade which has an inverse. I'm looking to potentially, best case scenario, make less than what I risked. That's inverse reward to risk. Totally not interested in that at all. You want to go for, say, if you're risking, say, £100 or $100 per trade, you want a minimum of £200 or dollars return for the privilege of placing the trade. Okay, risk management, we keep the risk low. It's very important. 1 or 2% of your account value risk per trade, no matter how good the trade looks. Okay, a lot of people, when they're new to trading, they think, okay, this setup is the classic textbook setup. I'm going to risk 10% of my trading account or 5% of my trading account. And of course, when that happens, it's tempting fate, because I've often found actually that sometimes the most obvious looking trades are the ones which bite the dust, and it's the second setup that happens after the inverted commas perfect trade is the one that makes some money. Okay, the markets are designed to trick people, and goodness, they really do a very good job in tricking people, especially newbies who are all out making a quick buck. Okay, so you could do a lot worse than risking 1% of your trading account per trade, and not a penny more, not a dime or a cent more. Okay, if you're consistently profitable over 6 months, then increase it to 2%, but no more than 2%. I risk no more than 2%. Okay, using a stop loss on the same kind of like theme. Using a stop loss is absolutely essential. It's a set of orders left with the broker, which essentially gets you out of the trade if things don't go to plan. You wouldn't go bungee jumping without a cord, and going trading without a stop loss is tantamount to suicide, really, because like I said, there's no such thing as a perfect setup in trading. You might get a perfect setup, but it loses you money. But every trade setup has its own quirks and nuances going on at the same time, and it's up to us to apply our strategy within a rigid kind of framework, i.e. our strategy, and follow a set of rules in terms of our rules for entry, management, and exit. Okay, and again, just to reiterate the point, having the ability just to simply rationalize when you place your trades, saying, hey, if I'm right, I can make this much money. If I'm wrong, I only lose this small amount of money. So I'm just going to sit back, relax, and really just kind of like not look at the screen. A lot of people when they're new to trading think that watching their trade live on the 5-minute chart will actually help them make more money subconsciously. That's not the case. Actually, it's pretty exhausting when for every time the chart moves in your favor, you get an emotional high, but when it moves against you, you're thinking, damn, I should have exited, damn. And it's absolutely exhausting when you're emotionally attached to the outcome and you're kind of wishing the market along when you're looking at it. You should not be doing that. It's a great way to induce premature hair loss. Find a few hobbies if you're trading end of day or end of week, and just find some things to distract you from the screen. Okay, you should rationalize in your mind, I'm taking this trade with this profit potential, I've set the orders up. If it goes wrong, I lose 1 or 2% of my trading account. If it goes right, I could make this much. Done. Walk away and forget about it. Okay, so like I mentioned, just to recap, we need, in order for the ingredients of a successful news trading Style is a profitable strategy at a stable time frame, like the daily or the weekly. Positive reward to risk setups, and we can identify them quite easily. Risk management, i.e. having a minimum of 1 or 2% per trade, no matter what, no matter how good the trade looks, and of course using a stop loss. The most important one, up there with risk management, up there with oxygen, is the ability to forget about the trade, sit back and relax. Okay, so let's talk about risk management now very quickly. I know a number of you are probably quite well aware of risk management because, well, as it should be, it's one of the most important things for any trader who's had any serious kind of intentions of trading long term. Okay, so in order to find our stake size per pip or per points, no matter what asset class you're trading, we divide 1% of our trading account. Say if we're trading, say, an account size of, say, £25,000 or dollars, 1% of that is £250 or dollars. We divide that by the difference between our entry price and our stop loss, which essentially gives us how much we risk per pip. Okay. And that's it, really. It's very easy. So we divide 1% of our trading account in monetary terms by the difference between our entry price and our stop loss. So give you another example. If we've got 1% of our £10,000 trading account and we've got a distance of 50 pips or points between our entry price and our stop loss, we simply divide 100 by 50 to arrive at a stake size of £2 per pip. Okay, so that is how we trade size. Reward to risk, we want 2 to 1 or 1 to 2 or better. Okay, so we want to essentially make double potentially in return than what we've risked on the trade. Okay, so why, ironically, a lot of people ask me, well, okay, Rob, so it's non-farm payroll tomorrow, what are you doing? And I usually reply saying, is it? I really don't know, I don't even care. Okay, so the irony of it is we actually do very well from trading the news without actually knowing or caring what the news announcement is or when it's released. Okay, so like I mentioned earlier, the harder time frame traded, the more immune it is to news announcements, and this will generally be because of the increased difference between our stop loss and our entry price. Okay, we've given the market more kind of like leeway and flexibility for it to potentially move against us before ultimately it could maybe move in our favor. Okay, so that coupled with the fact that being technical traders predominantly, okay, we look at some fundamentals, it's about 80-20, 80 technical, 20 fundamental. We trade what we see largely, not what we think. Okay, very important expression. Okay, because if we pollute our thinking with everyone else's opinion out there in the wider world, we could find ourselves more confused yet still. Okay, so we are not necessarily fundamentalists. We use the fundamentals in order to set the tone, set the scene, or the theme. Okay, but we are very rest assured that we cannot, and absolutely cannot or will not be able to predict news, but we use that to our advantage. Okay, you've got a lot of firms out there who have these research departments, and they spend hundreds of thousands of pounds or dollars on researching or finding out the probability of a certain kind of like of whether the data released in a certain country is going to be better than last time, or what it's roughly going to be, so that they can essentially have a winning outcome in terms of risking a trade in the market. But if you think about it this way, it's either 50-50, the news, whatever it might be in any country at any time, 50-50% chance of you being right or wrong. Is that binary, night or day, black and white, either right or wrong. Okay, we need to accept we haven't got access to like inside circle government quangos. We haven't got, unless you know any any insider trading contacts or anything like that. So we just need to be quite cognitive with it and just accept that there's a 50-50 chance the news will either go in our direction of the trade or not. Okay, so we use the chart, what the chart pattern is telling us, to gauge probabilities and see if the reward to risk stacks up in our favor. Okay, so we do it this way. And it's very much like risking or flipping a coin, if you think about it in this analogy. When we're talking about heads and tails, when people say choose heads or tails, you know full well that unless it's a black swan event, that it's a 50-50 chance of the coin landing on heads or tails. So if we can essentially, through a combination of positive, looking for setups with positive profit potential and keeping the risk to a minimum, we can manipulate things so that if we're right, we're rewarded handsomely by the market, and if we're wrong, we only lose a small amount of money. Okay, so if you think about it, if the 50% or half the time we're right, we make say £300, and whenever we're wrong, the other 50% of the time, we lose £100 or $100, then that's quite a worthwhile proposition. Okay, you'll keep on flipping that coin, knowing full well that the 50% chance you're right, you'll earn far more than you stand to lose than you're wrong. It's almost like a win-win situation actually in your favor. And it's the same philosophy which we apply to financial markets. Okay, we look for setups with high profit potential, knowing full well that if the news happens to agree with our direction, then at least the news will help to perpetuate a winning trade and make us more money. But if we're wrong, at least we only lose a small amount of money thanks to our risking 1 or 2% of our trading account. It's that simple. Okay, so we can always determine this before we enter the trade. Our stake size, however much we're prepared to lose per trade, no more than 1 or 2%, and we always find the setups with decent or positive reward to risk. But we need to be very careful now, because a lot of people, there's a big gap between what is reasonably possible in terms of the market delivering this outcome versus what the trader wants to happen. And what the trader wants to happen is normally confined to fantasy and in their wildest dreams. Okay, but remember full well that the higher the reward, the lower the probability of the market hitting that target. Okay, so going for a 2-to-1 as a conservative first target is decent in being conservative. It's quite likely that the market will reach that point. Okay, so in terms of finding the formula for looking for profit potential when it comes to placing the trade, we do it by simply having the difference between our entry price and our target price divided by the entry price and our stop price. Okay, and that is, say for example, the difference between our entry price and our target price is 178 pips, and we divide that by the difference between our entry price and our stop price. That's a 3.9 to 1 reward to risk trade. So if we are, say, risking say 1% of £10,000 or dollars, that's £390 return, risking £100 or dollars. That's a good return, and that's an outcome that can be quite quickly facilitated by a news announcement going in the same direction of the trade. Let's look at this example here. This is Euro GBP some time ago actually, where we risked 67 pips and we had a profit potential of 246 pips, because and that's actually a very good profit potential. That's a 3.6 to 1 reward to risk trade. And if, say for example, the ECB had a rate decision that day, at the same day we had that bearish pin bar reversal at the top of the range, we would still take the trade, knowing full well that if the ECB decided to keep interest rates the same or reduce them, then that will help our euro sell versus the British pound trade a lot more, and we would make, say, 3.6% return on what we've risked far quicker than if, for example, the ECB decided, God forbid, to increase interest rates. That would send our trade the other way and we'd lose 1 or 2% of our trading account. Okay, so essentially we've got the technical setup to sell at the top of the range. We're risking 67 pips, say $100 on a £10,000 trading account, and if we're wrong, we lose £100 or $100, but if we're right, we can make £360 or dollars. Makes logical sense to place that trade regardless, knowing that if we're wrong, 50-50 chance we're wrong, we lose 1%. If we're right, we can make 3.6. Okay, with this one here, this was an interesting one actually. I remember this trade very clearly. This was off the back of the election, the Tories versus New Labour in the United Kingdom. We had this 2 years ago. We had the election. It was a very hotly contested race between David Cameron and Ed Miliband. And we had this technical buy setup on the daily time frame. It was a buy the dip setup, bullish pin bar reversal, and we had 838 pips potential reward, risking only 186 pips. So it's a 4.5 to 1 reward to risk trade. Now, we had absolutely no idea at the time of placing this trade who was going to win, the Conservatives or New Labour, but we knew that if the Conservatives won, we could expect the British pound to rally, but if New Labour won, we would expect the British pound to fall. That was given because historically financial markets prefer a Conservative party because they're more business friendly. But we had no idea who was going to win because the opinion polls were very, very equal indeed. So we just traded it anyway, okay, because we knew full well that if we were right, we would make 4.5% return on our trading account. And if we were wrong, we'd only lose 1%, my apologies. I repeat, if we were right and the Tories did win, then it will help to perpetuate our winning trade direction based on a technical entry, a technical setup, and we would make 4.5% return on our trading account, risking only 1%. If we were risking 2% like we do, it would have made 9% very quickly. But if we were wrong, then at least we would only lose 1% or 2% maximum, risking 2% of our trading account per trade. Okay, so here are a couple of examples of how we've used news to our advantage. Okay, essentially I'll just tell you now, and I just want you to bear this in mind. We use news as a catalyst. Okay, we don't care what is happening and where. I admit this is my dirty little secret. I don't really keep up with Forex Factory. I have no real interest in knowing what news is announced or where. I'm setting off the fact that if I'm right, news will help at least, and it's 50-50 chance that I'm right or wrong. News will at least help perpetuate a winning trade, and I can get a positive outcome out of it. And if I'm wrong, then at least the loss is small, risking only 2% of my trading account maximum. Okay, so we took this trade in December 2015, and it was a Brexit trade. It was a setup based on a theme. Okay, we had the technical setup all the way back in December 2015, about 6 months before Brexit referendum. But we had the technical setup where we had a bearish pin bar reversal at the top of a very long-term range. It's at a multi-year high, and it was also the lower high of this multi-year high. As we can see, lower high. So we anticipated that this was the lower high in a double top reversal pattern. So we placed our entry just at the break of the low, stop was above the high, and we just left it. Okay, there was very, very good reward to risk, 18 to 1, but it was actually far more than that after we scaled out. Okay, so we knew full well that, okay, whatever happens with Brexit, which was 6 months later, at least we've got some good profit potential before then, by virtue of the fact that the market has time to move, and we can essentially just lock in profit by moving our stop loss and scaling out. Okay, but to all intents and purposes, looking at this setup from a pure technical perspective, on that time frame, we can see that we're risking 76 pips to make 1,404 pips, 18%, and that's about 38%, risking 2%. Okay, so that's not a bad return if you're risking £100. And this is the important thing about trading setups with high profit potential. Okay, I think anyone would trade a setup where if they only risked £100 and there's a decent chance they could make up to 1,800, then a lot of people would do that. I certainly would. But would you have taken the setup on based on what you've seen? Okay, we actually did very, very well on this one. Just take it all the way down from this point to this point. We made 18%. We had multiple opportunities to add to the position based on trend-based strategy. We entered here and here. Some of our clients doubled their money on this trade, and they did fantastically well from it. It's a very, very easy long-term trade setup. Okay, like I mentioned, the general election in 2015, we had the Tories versus New Labour, David Cameron versus Ed Miliband, and we had this bullish setup. It was the eve of the general election results. Okay, it was the election in the daytime. People counting the results. We knew full well that the results would be released the next day, and we knew full well also that if the Conservatives won, the British pound would rally. If they lost, the British pound would collapse. So we just placed our trade anyway because we knew that, okay, we've got decent profit potential, and if we were right, that is, and if we're wrong, we only lose a very small amount of our trading account. is that simple. Okay, so like I said, if we're right, we make potentially 858 pips. The good news in our favor of our trade will help to accelerate this as a catalyst, essentially. And if we're wrong, at least it's a relatively painless, fast exit. That's the main thing, okay, rather than having a trade that's losing you money and it's gradually, it's just you're in the trade for such a long time and it's doing nothing but just losing you money. They're horrible, those kind of trades. And I just say if the news just quickly whips you out of the trade quickly, then that's good. That's good enough. So, yep, it hit target in the end. Clients made 4.9% on their trading account, risking just 1%. Okay, so if they risked 2%, that would have been an easy 10% gain. Okay, because the Tories did win, and that's the thing. Had New Labour have won and Miliband have won, then they would have lost 2% on their trading account, risking 2%. But as the 50-50, they were right. Obviously, there was no way to guess who was going to win the election. The Conservative Party or New Labour, it was all 50-50, neck and neck, throughout the exit polls, throughout the opinion polls before the election and during. It was basically, okay, if the Conservatives win, we make potentially 10%, risking 2% of our trading account. If we're wrong, we lose 2%. Okay, it's a worthwhile trade, and we had that profit potential based on this bullish pin bar reversal and in an upward trending market where the market has been before, and that's always going to be a very good target if we're buying essentially a complex dip in an upward trending market. Okay, so that was a good one. We also talk about the FTSE, which for those of you around the world who might not be familiar with UK stocks, we have the FTSE 100, which is basically a basket of Britain's best and largest companies, and we traded this on the daily. This was at the time of the Scottish referendum, which was all very worrying in 2014, when an increasingly vociferous independent Scotland, pro-independent Scotland SNP wanted to break away from the 300-year-old union with Great Britain, and of course that would not be very well received by financial markets, because of course financial markets do not like uncertainty. They like the stability and continuation of the status quo, because things are predictable and outcomes can be assessed more easily than uncertainty. Okay, so we knew we had this sell set up on the FTSE 100 pretty much on the same day as we had the election, the referendum, as to whether Scotland wanted its independence or not. So we knew full well that if Scotland got their independence, then it's likely the FTSE would absolutely collapse, as well as the British pound. But we knew that, okay, if Scotland voted to remain in the Union, then the FTSE will either remain unchanged, i.e. the market's expected that Scotland will remain, or rally with the confidence that, okay, it's all safe now. We know what's going to happen in the United Kingdom from now onwards. But we had the technical setup, so we would take it anyway, knowing full well that if Scotland voted to leave, we'd have some serious profit potential with our entry just below the low of this bullish pin bar reversal, stop loss above the high, potential profit all the way down here. But if Scotland decided to stay, then we would lose the trade potentially, but it's fine, because frankly, as a Brit, I didn't really want Scotland to leave. My family are Scottish originally. I was just thinking, why would you do that to yourself? So anyway, we placed our entry below the bearish pin bar reversals low, stop loss above the high, and we had a small amount of risk, i.e. 38 points, and we had 330 points potential reward. Okay, not bad, 8.6 to 1. So if we'd risked £100, say 1% of our trading account, say for example it was £10,000, then we could have made 490 return. That's a worthwhile proposition. Okay, so we some of our clients got pinged out of this trade, but some of them managed to keep a half portion down to the lower quartile of this range. Okay, so yeah, the Scotland did actually vote to remain in the Union, and that was all great, but the FTSE sold off anyway. So that's just a key example of a news trade that, even though we were even though we were at the wrong side of the news, it actually went our favour anyway, stubbornly. Okay, so one thing I'm going to talk to you about before we draw to a close is ask you how trading makes you feel, okay? Because if you're anything like I was, when he first started trading, I had a fear of losing the trade that perpetuated a fear of winning. I was very outcome attached. A lot of ego was invested in trading as well. And after spending a certain amount of money on education and giving a certain amount of money to the market, I felt very entitled to wins. And I find that I exit wins quite quickly. I was very doubtful of myself, and that got me very angry and frustrated. And this in turn caused a vicious circle of self-sabotaging, not taking valid setups that fulfilled my rules. I was just trying to find anything just to make a quick buck. I found myself, after numerous losses, cutting winning trades far too early, and I would take full hits from my losing trades without reading the warning signs, and that of course eroded my trading accounts with 1,000 paper cuts back in the day, causing me to be even more angry and frustrated. Okay, but trading doesn't need to be like that, I can assure you. Trading, certainly in the style of the lazy trader, should make you feel calm, patient, and relaxed, that your trades are working overtime on your behalf, making your money work hard for you, whilst you go about your day doing slightly more exciting things and looking at the chart all day. So it should make you feel calm, confident in your strategy. You should not be outcome attached. You should be very rational in your thinking. You should not feel that the market owes you a living. It doesn't owe anyone a living, actually. And you should be optimistic that if you're right, you're rewarded well, and appreciate that losing the battle is part of winning the overall war. Okay, and that will in turn cause positive habits, like only taking setups that require your rules. You will not be hankering to get into a trade every 5 minutes just to say that you're in the market. A lot of people, funnily enough, actually, they take up trading not to make money, but just to swing the bat. It's absolutely staggering, actually, how many people will trade a demo account, but will actually just call themselves a full-time trader, and just makes it sounds impressive, I guess, to their peers. Appreciate as well that anything can happen at any time. And sometimes the best looking opportunities, the most obvious looking setups, can sometimes bite the dust, but we take them anyway, because if that good looking setup goes in our favor and we're not taking it as a valid setup that fulfills our rules for entry, then you'll kick yourself, and quite rightfully so. The frequency of opportunities, whether they're wins or losses, the frequency of setups that fulfill your rules for entry, are they completely random, a bit like buses turning up at the same time in any major city, whether you're in New York, London, Los Angeles, Sydney, Singapore. You know, there's always that. You know, they call it variance. Sometimes you'll get opportunities that happen. You'll be waiting a long time, and nothing happens, and then suddenly they all come at once. Okay, and a big part of success is to make sure you trade setups that win big and lose small. That will make money long term, and that will in turn help perpetuate your long-term trading as a peaceful and relaxing hobby, which happens to pay. Okay, so this is where, in order to achieve this, you need to separate your heart from your head and be very logical about it. Trade with money that you can afford to lose. Okay, the worst thing you can do is trade with a huge amount of money before being consistently profitable. And because then every time you'll be placing a trade, you'll be worrying about it, and that's a lot of mental energy burnt. Okay, you should be trading with a small amount of money, that if you did lose a trade, it's no big deal. And I can promise you, if the outcome of your trade is no big deal in financial terms, you'll be a lot more rigid in the way you manage your trade. Okay, it's because it should be a boring activity. It should be a run-of-the-mill habit when you're managing your trade and placing your trades. Okay. So having realistic expectations is very important. You should never trade with money that you cannot afford to lose. Never trade with more than 2% of your account's value. Always use a stop loss. Always trade setups with positive reward to risk. Let your winners run. That is so important. Okay. So being realistic and fair to yourself, treat it like a long-term game, not like an amusement park, the financial markets. Like I said to you before, it's all about losing a few battles before winning the war. Losing is part and parcel of trading. Keeping the risk small, using a protective stop loss is essential, and that will help you become calm, disciplined, and patient, confident in your strategy and your approach, and will help you to appreciate the market is a vehicle that we use. It's not our friend, it's not our enemy, but it's just a forever shape-shifting organism that we need to basically ride the coattails of and just use the strategy we have chosen in order to do that. Okay, so in order to reach a conclusion about how to trade the news, I just want you to really kind of like etch into your mind that we don't trade the news directly. We just happen to use it as a catalyst. Okay, news creates volatility and movement. Okay, and this volatility can either go in one of two directions. It can go in our favor or it can go against us. And this really does depend on the difference between what the market expects in terms of the news or the data release and what the news actually is. Okay, it's 50-50. It will go in our pre-existing trade's direction or not. And if we're already in the trade and it does happen to be in our direction, we can piggyback this big move and it will help to accelerate a profitable position. And if we're on the wrong side of the news, then at least our loss is relatively small, risking no more than 1 or 2% of our trading account. But if the news is in our favor, we can piggyback that big move and it will help to perpetuate a winning trade far faster. Okay, so looking for setups with big profit potential, high profit potential, while keeping the risk low, whilst using news as the catalyst, i.e. helping us to reach our outcome faster, is a great way of trading the news. Okay, that is it. So I appreciate you're all very busy and you're keen to learn how to trade, and I feel very humbled and delighted to obviously have the opportunity to present to you today. And I did want to reward you for taking time out of your schedule to come and join us. So in conjunction with Traders Talk Live, I did want to give you a special access to our flagship online trader training program, which has been valued at $1,997. I want to give you 1 month test drive for $1 only. Okay, $1 only, when on the website is $252, and this will give you access to all of our training, no holds barred, basic and advanced strategies, our trade ideas, weekly market analysis. You'll have our monthly fundamental market analysis. You'll have access to our forums, which are moderated. We are CPD accredited as well, so you can be rest assured you have a quality experience of us. You'll get pattern recognition software. We've got this new product traders hypnosis audio course. You'll have access to all of our training modules and flip books. We've got quizzes as well, so you can assess your performance along the way. And this is all access for $1. Okay, and all you need to do is just go to our website, www.thelazytrader.com/forex-training, read the terms and conditions, buy the ultimate program, and use the promo code TradersTalk lowercase, and you'll have access to that. Okay, we've had great reviews on Forex Peace Army. We've been accredited by the CPD. We've been featured in lots of publications. Okay, do not confuse us, please do not confuse us with Lazy Trader app online, because that is a scam. This company is based in Bulgaria and they have piggybacked our reputation. They've got a different website called the Lazy Trader app, and it's a pure scam. So please do not confuse the lazytrader.com with the Lazy Trader app. They're a completely different entity, and as far as I'm concerned, they do not have a very good reputation at all, according to what I've read. Okay, but this program, if it's for you, then fantastic. We look forward to welcoming you aboard. We're about to have a big upgrade with the members area, and we've got about well over 50 hours of training on there. And it's essentially the ultimate program. What it is, we charge $252 enrollment fee, and it runs onto a subscription, $160 per month thereafter. But what this is this is the $1 deal, so you don't have to pay the $252 enrollment fee. Okay, you can trial run it for a month for $1. Okay, and if you're not satisfied, we'll just give you your dollar back. We've yet for someone to do that. Okay, so it's your full support system if you want to essentially trade in the way of the Lazy Trader, and we specialize in teaching people how to trade the daily and the weekly time frame so that they can get the best out of financial markets trading without having to spend all day in front of the screen, so that they can make more from trading with less time invested. And you've got your full support system there. Okay, well, thank you very much indeed for your attention, and hopefully we'll see you on board